In terms of our economic outlook, we do believe we're in the midst of a recovery. Of course, this is coming after one of the largest economic shocks that the U.S. economy has ever gone through. So, although we are in the midst of a recovery, unfortunately, it's going to be a long recovery. It will be frustratingly slow in some sense. And to give you a sense, we don't think we get back to late 2019 growth levels until the end of next year at the earliest. And if we do face some unanticipated negative shocks to the economy from here, that ultimate recovery could get pushed even further forward in time. So what this means, of course, is that the worst may be over from a market volatility perspective. We do expect to see a steady decrease in the unemployment rate, increase in GDP growth, but it's going to be frustratingly slow. There are going to be segments of the economy, industry out there here in the U.S. As well as other countries around the world that continue to struggle because this recovery is going to be somewhat sluggish and somewhat uneven. And we know in a lot of segments of the economy that have been most impacted by this unfortunate COVID or health-related crisis, they may never fully recover, or at a minimum will need significant ongoing financial support, and in some cases may not avoid restructuring or at least the need for additional capital going forward. One term we use a lot in thinking about overall portfolio construction is resiliency. And again, as uncertain as a macro environment as we're currently operating, capital preservation, resiliency is very, very important. One area where we continue to see significant resiliency is in the residential mortgage space broadly. By broadly, I mean not only in this country, but even in other segments of the developed markets as well, with an eye towards Europe in terms of more immediate opportunities. This is a segment of the market where there's been sufficient conservatism on the underwriting side and sufficiently strong fundamentals where many of these investments can continue to perform even in a world of declining home price values in the areas, again, where we operate. One of our favorite sectors, a sector where we have massive amounts of resources in an area where we'll continue to look to deploy capital. Similar story, perhaps with slightly less conviction in the broad asset-backed categories, particularly consumer-related asset-backed securities. Their fundamentals remain relatively strong as well. You do have to differentiate across the subsectors of the market. But what we like about that space is that in addition to a promise to pay, you have investments that are backed by hard assets, whether that's automobiles in the case of an automobile pool, other types of consumer secured receivables. You do get that added protection. So again, even if you were to get into a much more protracted economic downturn, still the type of resiliency that we're looking within this space. And last but not least, the corporate credit opportunity set today, at least on a targeted basis, is as attractive as we've seen in many, many years. Going into late 2019, spreads were quite tight, and it was an environment where borrowers had most of the leverage, very little in the way of covenant protection. A lot of the deals that were coming to market, in our opinion, had inadequate security packages or covenants. That has all changed over the course of the last few years. So although generic credit beta has rallied a lot, generic IG or investment grade and high yield spreads are looking a little bit less interesting, given the rally that we've seen. There's still a steady stream of opportunities within the corporate credit space, and the opportunity as investors in this space to drive, pretty attractive terms for us as lenders.